Welcome to TheoTrade. This is Don Kaufman. It's August 15th, 2018. You are watching the Theo Night video. People, there's just about 12 to 13 minutes to go to the closing bell, and we've seen quite the degree of volatility inside of today's markets. With that, let's kind of get started here. So the S&Ps are down just about 20 handles right now, but they are well off the lows of the session, which is just shy of the 2,800 marker. Now, with that, there is, as I said, kind of a degree of volatility, and that volatility is likely what we talked about specifically on Monday, and that was really volatility that was spilling over from the currency markets and from the emerging markets into the U.S. equity markets. However, what I'm going to show you in the next few moments over here, just allow me to tell you, this appears, and the volatility that we're seeing today, to be nothing more than an appetizer at this point in time. So again, the resilience in the marketplace, I fully would anticipate more volatility and more sell-side activity. Let me get into specifically why we think that there's more volatility kind of lurking out there in this marketplace. Let's move, to an area that we have talked about a bit recently, but haven't spent any real detailed time on, and that happens to be the VVIX. This is the volatility of the volatility index. Now, granted, it is off its highs of the trading session. Now, the VVIX, the volatility index, effectively means who and what, are buying options specifically in the VIX. And the VIX spiked almost to 17 today, reverted all the way back to 15. So everybody says, that's it, it's all over, put down your weapons and ammo, we can all go home happy. Except the VVIX tells a vastly different story. Anytime that VVIX gets above, and I like big marquee levels in this case, right above like 110, when the VVIX is above 110, and I'm actually going to switch this to a daily chart, that for the most part, means duck, cover, right? Because what it's actually telling you is the rest of the trading world is doing, just that. It's a duck and cover kind of a move. Now, it effectively means that anybody who's anybody has gone out and they've already mitigated the larger degree of their risk. How do they mitigate their risk? How do they control their risk? Well, clearly by buying what? By buying calls in the VIX itself. That's why the VVIX went up to begin with. But that unto itself doesn't mean a whole lot. Let's look at a couple of other kind of key aspects in the marketplace. And we're going to switch gears once again and go from volatility. So listen, this doesn't mean per se that the market's going to tank. It simply means that you know that the professional world has offloaded a very large amount of their risk. The next thing I would go to would be the advanced decline line. Now, when the markets opened this morning, we were heavily correlated. And this is, again, to display the resilience, if anything, in the marketplace. This morning, we had 90 decliners, 10 advancers in the S&P 100. And again, that's a display of larger risk. Anytime we're seeing markets that are heavily correlated, the movement of the overall market is going to be exaggerated. Hence, we see some fairly wild swings today. But as I was saying, you kind of got the feeling throughout the course of this morning that there was nowhere to hide. However, as this day progressed, if you take a look at the sectors themselves, we did actually see areas and pockets that were popping to the upside. Now, each one of these happens to be highly defensive positions. For the most part, when you see traders running into utilities, and utilities are well off the highs of the session, when we see traders though running into utilities, you get a little bit nervous at that point. But again, I don't want to digress too much, as those are just, once again, hedging tactics. They don't say per se that the marketplace is going to tank. It's just displaying that traders are offloading a vast amount of risk. The currency markets right now, there is still chaos a-brewing inside of the dollar. The dollar peaked out early this morning, and actually pulled in. One of the things, Keep perspective on this in the days to come. One of the things you really need to watch, strength in the dollar in the last few sessions has meant weakness in the overall markets. Okay? And say what you will about the dollar, but it has actually popped through and continues, okay, to be quite resilient to the upside. Now, again, in today's trading session, it did revert back down as we're coming towards the cash close. With just minutes to go here, you can see the dollar popping back up. I would anticipate more strength in the dollar, more weakness in overseas markets, okay? And again, the currency volatility is simply spilling into the S&Ps. However, therein lies a much larger issue. And what is specifically at issue? It's the fact that the volatility that we're seeing in the currencies is absolutely unprecedented. What we're seeing right now in terms of the S&Ps, oh, come on, people, this is mild. We haven't seen anything yet. This is not even a full 1% move. You know, the S&P futures today, they're doing 1.6 million contracts. Just so everybody's aware, okay, there's some activity, again, kind of brewing in the S&P contracts. Now, granted, this is a decent-sized day in the marketplace, but look at the contract size that's flying in the S&Ps. Once again, that's indicative of anybody that knows what's going on. They're offloading risk. So at this point in time, okay, given the volatility overseas, given the volatility that we're seeing, you know, kind of creep into the currency markets, we expect that this in the S&Ps is nothing more than the appetizer, which then brings me over to the SPX. Now, why am I going to look at the SPX? Because I want to give myself orientation of where we are on the week in terms of expected move. So this is, I believe, of critical importance. The move was expected this week to be $42 higher or $42 lower. We came down today, but we're not home yet. We could actually come right into somewhere right around the 27.90 before we would even crack into the edge of the expected move. Okay, given where we're at right now, again, I would fully anticipate we have more than enough volatility left in us to actually breach the lower end of that expected move in the week. Now let's get really specific. Let's cruise over to the SPX. Cruise over to the SPX and look at the Friday expiration. There's still almost $28 of expected move packed into this market. And I got to show you something here because you're going to find this quite ironic. If you take a look, we just said there's about $28, okay? Take a look of where the S&Ps currently are. And again, I'm just going to highlight this. The S&Ps are currently at 28.19. Right down below here is 27.90. Do some quick math over there. If the S&Ps were to lose what? Well, basically the expected move, 28 points, they'd be sitting right on the edge of the expected move, okay, for this Friday's expiration, which also brings me to a point. You could absolutely look, right, at buying cheap butterfly trades out of the money in and around where the edge of that expected move is. Now, people, this is some low probability trading here. Nevertheless, okay, we're positioned perfectly to clip into the edge of the expected move on the week. And again, this appears to be nothing more than an appetizer. With that, last but definitely not least, I want a quick glance at the financials because I cannot stress enough in terms of a sector. Once again, we have a lot of people, they have their focus on the monsters of tech. Well, the monsters of tech are getting beaten up today. They're down 1.2% when the Nasdaq is only down about 1.1%. Okay, but the real focus, it should be the financials. They're showing, again, still a degree of resilience in this marketplace. And it's the financials that I ultimately believe are going to get hit the hardest in the next round of some sell-side activity. So be aware of it, okay? If you want and you're going to trade it, be in front of it. But it's the financials that I would expect would take the largest hit in the midst of some big sell-side activity. Again, when our focus is right here in terms of, are the monsters of tech finally going to roll over? Okay, that is not so much moving the S&Ps as is, okay, the financials. With that, thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.